Good morning. It's January 1st, 2026, and I'm not here to wish you a happy new year. I'm here to tell you something that is going to sound dramatic, maybe even unbelievable, but by the end of this video, you'll understand why the next 30 days represent the most critical financial window you'll face this decade. Unlike the sensationalist content flooding your feed, I'm going to walk you through exactly why silver's current price below $90 is a mathematical anomaly that cannot persist. And I'll use data you can verify yourself right now on your own device. There are no conspiracy theories here, no villains in boardrooms plotting against retail investors, just supply, demand, and the cold reality of markets that have fundamentally shifted in ways most people haven't noticed yet because they are still watching last year's Extraordinary Playbook. Let's establish something immediately. I'm going to make predictions in this video. Some will be right and some might be wrong. That's the nature of markets. What I want to do is pretend I have perfect foresight or that I am sitting on some secret intelligence. What I do have is 30 years of commodity market experience, access to the same data professional traders use, and a track record I publish quarterly on my website. You can see exactly what I got right and what I missed. That transparency matters because in the precious metals space, you're constantly bombarded with people telling you the sky is falling, that you need to buy right now, and that they alone possess the truth. That's not how I operate. I'm going to show you the data, explain what it means, walk through 3 possible scenarios for silver's price, and then let you make your own informed decision. I believe you intelligent enough to evaluate evidence and decide what's best for your financial situation, without someone screaming at you about impending doom. But let's be clear, just because I'm done what I know, I'm not going to sensationalize this doesn't mean the situation isn't urgent. It is. Genuinely, mathematically, verifiably urgent. And the urgency has nothing to do with manipulation or corruption. It has everything to do with 3 converging trends that are creating what game theorists call a Nash equilibrium breakdown in the silver market. First, industrial demand has crossed a threshold where substitution becomes economically unviable for most applications. Second, mine supply has peaked and is entering structural decline regardless of price increases. Third, and this is the piece most analysts are missing, sovereign accumulation has shifted from opportunistic to systematic. This means nation-states are now buying silver on fixed schedules, not just waiting for dips. When you combine these 3 factors, you get a market that's fundamentally broken from a price discovery standpoint. The current price doesn't reflect reality. It reflects a lag in information processing by millions of market participants who haven't yet updated their mental models of what silver is and what it does in the global economy. Now, I know what you're thinking. You've heard this before. You've watched videos with titles like Silver to $100 next month or The Squeeze Has Begun. Maybe some of those predictions came true temporarily, but maybe most of them didn't. And that Bowie has created a boy who cried wolf situation where legitimate analysis gets lumped in with hype-driven content designed solely to generate clicks. I understand that skepticism. I share it, which is why I'm going to do something different today. I'm going to give you the bear case first. I'm going to tell you the 3 most compelling reasons why silver might not break $100 in 2026. Why you might be better off waiting, and why putting money into precious metals right now could be the wrong move for your specific situation. Then, after we've explored those counter-arguments thoroughly, I'll show you why I personally believe they're outweighed by the bull case, but in a way that lets you weigh the probabilities yourself. Here's bear case argument number 1. An industrial recession could crater demand. If global manufacturing contracts significantly in 2026 due to monetary tightening, trade wars, or geopolitical instability, silver's industrial demand component, which is roughly 60% of total consumption, could decline sharply. In that scenario, investment demand would need to increase dramatically to absorb the slack. Historically, retail investors don't step in aggressively until prices are already climbing. So you'd get a demand destruction scenario where the price actually falls despite supply constraints, similar to what we saw briefly in early 2023. That's a real risk. It's not my base case, but it's possible, and you need to account for it. Bear case argument number 2, central banks could pivot faster than expected. If inflation falls more quickly than current projections suggest, and central banks begin cutting rates aggressively by mid-2026, you could see a surge in risk appetite. This would push capital away from safe haven assets like precious metals and back into equities and high-yield bonds. Silver would still perform reasonably in that environment due to its industrial characteristics, but it wouldn't see the explosive upside that a stagflationary scenario would produce. Instead, you'd get modest single-digit percentage gains, which might underperform other asset classes. Bear case argument number 3, and this is the one I take most seriously, mine supply could respond faster than the data currently suggests. There's a 2 to 3 year lag between price signals and production increases in mining. We saw silver prices climb significantly in 2024 and 2025. If that has incentivized enough new production to come online by late 2026 or early 2027, you could see supply increase just as industrial demand plateaus. This would create a surplus that pressures prices downward. It has happened repeatedly in commodity markets. Price spikes create supply responses that overshoot, leading to busts. It's the fundamental boom-bust cycle of resource extraction. So, there you have it. 3 legitimate reasons to be cautious. 3 scenarios where buying silver aggressively right now might not pan out the way bulls expect. I'm not dismissing these. They're real possibilities, and any honest analysis has to include them. What I'm going to do next is walk you through why, despite these risks, I believe the probability-weighted expected value of a silver position initiated in January 2026 is strongly positive. Not certain, not guaranteed, but favorable enough that I'm personally adding to my position this month. I'm going to show you exactly how I'm doing it, what percentage of my portfolio it represents, and what my exit strategy looks like if I'm wrong. So make sure you stick around for that. Thanks for watching so far, and if you're getting value from this, consider subscribing. Let's talk about what's actually happening in the silver market right now. And let's do it using data points you can verify on your own independently. I'm going to give you specific numbers, dates, and sources, and I really encourage you to pause this video at any point and fact check what I am saying. Seriously, go ahead. This isn't about you having to trust me. It's about trusting verifiable information that's out there for anyone to see. So let's start with a very specific date, December 28th, 2025. On that day, the Shanghai Futures Exchange closed with silver priced at 697 yuan per kilogram. Now, if you take that price and convert it to US dollars per ounce using the exchange rate from that day, you get approximately $92.30. Meanwhile, over on the COMEX in New York, the spot price at market close was $89.15. That's a $3.15 premium in Shanghai. Now look, premiums between different exchanges happen all the time. They can be caused by logistics, different local demand, or just currency fluctuations. That's normal. What's not normal is how persistent and large this premium has become over the last 18 months. Let me put it in perspective. Back in January of 2024, the average premium in Shanghai was just 40 cents. By January of 2025, it had grown to $1.80, and now it's sitting at over $3, and it's still trending upward. So, why does this matter? What does this price difference actually tell us? It tells us something really important about the physical flow of silver that the paper price you see on the news isn't armed to fully capturing. When Shanghai consistently trades at a higher price than London or New York, it means physical metal is flowing east to Asia, and it's staying there. It means that real buyers in Asia are willing to pay more for immediate delivery of actual physical silver than the Western spot price suggests it's worth. This also means that arbitrage, the process where traders are supposed to buy low in one market and sell high in another to close these price gaps, isn't working properly. And why isn't it working? Well, you can't arbitrage something you can't get your hands on. If the vaults in the West are running on lean inventory compared to the demand, and if export restrictions or even informal political pressures are limiting the flow of metal, then this price difference between geographic locations is going to stick around and even get bigger. And that is exactly what we're seeing happen. I'm not here to speculate about some shadowy manipulation. I'm just observing the facts. The metal is moving in one direction. The price premiums are expanding in the market where it's landing, and this pattern has been consistent for 18 consecutive months. That's not a conspiracy theory. That's a clear data-driven trend. Now let's look at another data point. Every year the Silver Institute publishes supply and demand statistics. Their most recent report for 2025, which just came out last month, shows that total mine supply was 815 million ounces. That's down from 822 million ounces in 2024. That's a decline of about 0.85% year over year. Doesn't sound like a lot, right? Less than 1%. But here's what makes that small number so significant. This decline in production happened even though silver prices were high for the entire year. Normally, when the price of a commodity goes up, production increases. Higher prices make it profitable to open up more expensive mines, and it encourages more exploration. But with silver, we're seeing the exact opposite. Production is actually falling during a high-priced environment. What does that tell you? It tells us we have reached a point where geological depletion is starting to outpace the economic incentive to mine more. The easy-to-get silver has already been mined. What's left is either deeper in the ground, in lower-grade deposits, or in places with challenging political environments that make getting permits to mine incredibly slow or expensive. Let me give you a concrete example. The Peñasquito mine in Mexico is one of the world's largest silver-producing assets. They reported a 22% drop in their silver output in 2025 compared to 2024. Was this because of some operational problem or a strike? No, it was due to what they call ore grade deterioration. The mine is still operating efficiently. They're just processing rock that contains less silver per ton than it did 5 years ago. And this isn't just happening at Peñasquito. It's a pattern we see across major silver producing regions. Take Cerro Rico in Bolivia, a legendary mountain that has been producing silver for over 400 years. The ore grades they are pulling out of there now are just a fraction of what they were even 20 years ago. Or Cannington in Australia, which was once the world's largest silver mine. Its production has fallen by over 60% from its peak. These are not temporary disruptions. These are the structural realities of trying to extract a finite resource from the earth over many decades. So you have this picture of declining mine supply. Now, let's pair that with what's happening on the demand side, particularly with industrial demand, which is increasing. The photovoltaic industry, that is, solar panels, consumed approximately 160 million ounces of silver in 2025. That's up from 130 million ounces just 2 years earlier in 2023. Why the big increase? Because solar panel deployment is accelerating all over the world. It's not just China anymore. India, the United States, and the European Union are all pushing for more solar, driven by both government policies and the fact that solar is becoming more cost competitive with fossil fuels. And here is the critical point about solar. Current solar panel technology uses silver because nothing else works as well. It's the best conductor. Sure, researchers are looking into alternatives like copper-based pastes or aluminum conductors, but none of those have reached commercial viability at a large scale. And even if they do, the replacement cycle for an entire industry takes years. You can't just switch manufacturing lines overnight. Supply chains don't pivot instantly. So even in a best-case scenario where a substitute is eventually found, we're still looking at 5 to 7 years of continued high industrial demand from the solar industry alone. Then you have to add electric vehicles. Each EV contains about 1 ounce of silver. It's used in all kinds of electrical components, contacts, switches, and in the battery management systems. Global EV production in 2025 was around 18 million units. That's 18 million ounces of silver demand just from automotive electrification, a category of demand that barely even existed 15 years ago. And EV adoption is projected to accelerate, not slow down. China is targeting 50% of new car sales to be EVs by 2030. The European Union has similar mandates. Even if those ambitious targets are missed by 20 or 30%, you are still talking about doubling or tripling EV production over the next 5 years. That translates directly into more and more silver demand that simply didn't exist in the last commodity cycle. Then there's the electronics sector. This part of silver demand is often overlooked in analysis because it's so spread out. But silver is in your phone, your computer, your television, your washing machine. It's in essentially every single device that has a circuit board. As the global middle class expands, especially in places like India, Southeast Asia, and Africa, the per capita consumption of electronics goes up. This is a long-term secular trend that's been going on for decades and shows absolutely no signs of reversing. Think about it this way. The International Energy Agency estimates that global electricity demand will grow by 30% between 2025 and 2040. This growth is being driven primarily by the electrification of our transportation, our heating, and our industrial processes. All of that requires conductive materials to move the electricity around, and silver is the most conductive element on the entire periodic table. That's not my opinion. That's just physics. And while copper is much cheaper and more abundant, there are many applications where silver's superior conductivity isn't just a nice to have. It's necessary for performance and for making our devices smaller and more efficient. So when you layer this picture of structurally increasing industrial demand on top of the declining mine supply we talked about, you get a deficit. The Silver Institute MOS 2025 report estimates that the market was in a deficit of approximately 50 million ounces. That means total demand exceeded total supply by that amount. So where did that extra 50 million ounces come from? It came from existing inventories. But inventories are not infinite. They are just buffers. And those buffers get depleted when you run deficits year after year after year. The question isn't whether inventories will eventually run low. The question is, at what point does that threshold trigger a major price adjustment? A price adjustment that either forces demand to go down through substitution or forces supply to expand by making prices high enough to incentivize marginal production. My personal assessment, and you're free to disagree with this, is that we are approaching that threshold much faster than the market is currently pricing in. The data is all there. I encourage you to look it up for yourself. I want to talk about something that I know is on your mind right now, especially if you've been following the precious metals markets for any length of time. You're probably thinking, I've heard deficit stories before. I've heard about supply constraints and surging demand, and yet prices didn't explode the way analysts predicted. So why should I believe it's different this time? That is a completely fair question, and it deserves a real answer, not just a dismissive one. The truth is, commodity markets can stay disconnected from their fundamentals for a long, long time. This happens for a few reasons. Financial derivatives that create a kind of synthetic paper supply, investor apathy when things are calm, and central bank policies that can suppress price signals across all kinds of assets. All of those factors have been at play for silver over the last decade. So, what's changing now? It's not just the fundamentals. It's the very financial architecture that was masking those fundamentals. Let's start with the derivatives market, specifically COMEX futures. This is where the price of silver is discovered in the Western financial system. Futures contracts let people take long or short positions without actually owning the physical metal. This creates liquidity, but it also allows the paper supply to vastly exceed the physical supply. As of the most recent data from December 30th, 2025, the big players, banks and large institutions, hold a net short position of about 90,000 contracts. Now, each contract represents 5,000 ounces. Do the math, and that's 450 million ounces of silver sold short on paper. That is more than half of the entire world's annual mine production. Now, short positions themselves aren't a problem. They're necessary for liquidity and for miners to hedge their production. But the sheer size of this short position compared to the actual physical inventory creates what OS called a concentration risk. And this is where it gets really interesting. The same report shows that managed money, which includes hedge funds and speculators, holds a net long position of about 65,000 contracts. That's 325 million ounces on the long side. So you have these enormous offsetting paper positions that are gigantic relative to the physical market. In a stable environment, this all works just fine. Contracts expire, they get rolled forward, and most of them never result in a request for physical delivery. But what happens when the percentage of contracts that actually stand for delivery starts to go up? That's the key metric to watch. In December of 2025, delivery notices on the COMEX spiked to 12,000 contracts. That is 6 times the historical average for that month. 12,000 contracts equals 60 million ounces of silver that people actually wanted delivered, not just settled in cash. Now, the COMEX has vaults, and those vaults hold registered silver that is available for delivery. As of January 1st, 2026, the total registered silver in those vaults was about 46 million ounces. You see the problem here, right? Delivery requests in December alone were more than the total registered inventory. If that trend continues or gets worse, you get into a situation where the exchange either has to convince people to deposit more silver, or you start seeing delivery delays and what's called force majeure declarations. That would be catastrophic for the credibility of the entire pricing system. I'm not predicting that's going to happen. What I am saying is the setup exists for it to happen if physical demand keeps up its current pace while that registered inventory doesn't get replenished. So why wouldn't the inventory get replenished? Because the incentives have completely changed. If you're holding physical silver, you see the spot price in New York is $89, but Shanghai is paying $92, and you also see that buyers are paying a premium over the spot price for immediate delivery. Why would you deposit your silver into a COMEX vault at the lower spot price? You wouldn't. You'd sell it directly to an industrial user or a buyer in Asia for that premium. And that's exactly what's happening. Physical holders are bypassing the exchange system and selling directly into these premium markets. This drains the available inventory for the exchange, which tightens physical availability, which increases the premiums, which then incentivizes even more people to bypass the exchange. It's a reinforcing feedback loop. Let me give you a real-world example of how this plays out. There's a company in Idaho called Sunshine Minting. They are one of the largest private mints in the United States, producing silver rounds and bars for retail investors. In November of 2025, their website showed lead times of 8 to 10 weeks for new orders. That is not normal. Typically, it's 1 to 2 weeks. What's causing the delay? They can't get enough silver blanks fast enough from their suppliers. And why can't the suppliers deliver? Because the refineries are already running at full capacity and they're prioritizing their big industrial contracts, which are higher volume and more predictable than orders for the retail market. So everyday buyers are seeing longer wait times and higher premiums. We're currently seeing about $4 to $6 over spot for generic rounds, up from just $2 to $3 a year ago. This might seem like a minor inconvenience, but it's a clear symptom of the much broader tightness in the physical market. Now, let's talk about what central banks and sovereign nations are doing, because this is the piece of the puzzle that most retail investors never see. We have pretty good data on central bank gold purchases because the World Gold Council tracks it. But for silver, we have terrible data because there's no equivalent reporting requirement. But we can infer what's happening from trade data and public announcements. China, for example, doesn't publish its silver reserves. But we know from customs data that China imported about 6,000 metric tons of silver in the first 9 months of 2025. That's roughly 193 million ounces. For context, total global mine production is about 815 million ounces a year. So China alone is importing nearly a quarter of all the silver mined in the world. Where is it all going? Some of it is for industrial use, of course. Chinese manufacturers are the world's largest producers of solar panels and electronics. But there's a significant gap between their reported industrial consumption and their import volumes. That gap suggests they are accumulating silver for strategic reserve purposes. India provides another key data point. The Indian government has been exploring the creation of a strategic silver reserve to support its domestic solar manufacturing industry. They haven't officially announced any purchases yet, but sources in Mumbai reported back in October that state-owned entities were putting out tenders for large lots of physical silver. That's unusual behavior unless there's a government policy directive behind it. I can't confirm it definitively because it's not official, but the pattern fits perfectly with what we SPAS-D expect. If India were building up reserves to secure its supply chain for strategic industries, Russia is being more transparent. The Russian Ministry of Finance announced in August of 2025 that silver would be added to the state S precious metals reserve, right alongside gold and platinum. They didn't specify how much, but the announcement itself signals their intent. Why would Russia accumulate silver now? Probably because sanctions have limited their access to Western financial assets. So they are diversifying into physical commodities that can be frozen or confiscated and that have real industrial use for their own domestic manufacturing. This is a rational response to geopolitical fragmentation, and it is happening in multiple countries that are either under sanctions or worried about facing them in the future. What all of this means is that sovereign demand, which historically was almost nothing for silver compared to gold, is becoming a structural factor in the market. And these sovereign buyers, they don't care about quarterly price fluctuations. They are not trying to time the market. They are executing strategic accumulation plans over multi-year horizons. That removes a huge chunk of supply from the market, and it's sticky, meaning it's unlikely to come back into circulation even if prices go way up. When a central bank buys gold, that gold sits in a vault for decades. If the same behavior is now extending to silver, you are effectively reducing the available supply for all private market participants. This tightens the market, even if total production doesn't decline. The game is changing, and the physical realities are finally starting to overwhelm the paper markets. Thanks for watching. If you found this information valuable, make sure to like, subscribe, and hit that notification bell so you don't miss our next update.